Hello everyone and welcome. Glad to see you all here. This is Yanko speaking. At the beginning of a new week, we'll be reviewing this week some new trading strategies. The COP, the COP, Center of Price. We'll be reviewing some trading price action strategies. And on Wednesday, we'll review some of the previous strategies again and try to look for live examples on the market. I hope you can all hear me. So again, welcome everyone. If you could just please raise your hand or write something down to let me know that you can all hear me and see the screen properly. Today we'll be again reviewing the COP trading strategy, or the COP, which is center of price. It's a strategy which works well with S&P 500 on a 1-hour chart, but we'll look at some other time frames and try to look at some other charts. We'll review the system, but we'll also review some of the, in general, we'll review moving averages and how to work with them and how to combine them in trading. So I'll talk a little bit about this trading strategy. We'll go over moving averages and some of the moving averages I'm using in my trading. And again, we'll go back to this COP trading strategy and conclude the session. So again, thank you for joining. Please feel free at any time to raise your hand or just try to write the question if there's anything you would like to comment or ask. And we'll start. Again, all these trading strategies and templates and indicators, all of them are available through your via your your account manager. So you can always contact your account manager and ask for these indicators or templates or all these things I'm showing on the graph. You can always ask them to send you these strategies or systems, and you can always send me an email if you have any other questions or if you would like me to send you anything. My email, yanko.fx@gmail.com. And let's begin. Let's start with this trading strategy. This system, which is called the COP, COP for center of price. This strategy works well with the S&P 500 on a 1-hour chart, but also on some other time frames. It's a simple trading strategy, and it's a simple system. You can always create it yourself, create the template yourself by using the following setups. So first of all, we have 3 moving averages. The first moving average, the green one here, and by the way, this template is a bit different from the one maybe you saw on your email, because I changed the color a little bit. You can always change the color of the candles or the moving averages, the background, whatever you want. So I changed it a little bit, and the color, the green moving average here is a 5 exponential moving average applied to the close price. It's the fastest moving average in this system, and actually it's quite a good moving average, because when the market goes into a strong trend, this moving average usually uses as the first support or resistance, and well, it's quite fast, so it reacts obviously very fast to the price. Again, when you see a trending market, okay, usually this moving average is used as a good support or resistance. Okay, in an uptrend, it's a good support moving average. In downtrend, it's a good resistance moving average, okay? But that's not the main purpose of this moving average here. Here it is used mostly for crossing the other two moving averages, which are the 75 and 85 linear weighted moving averages. Okay, so the first one, the red one, is a 75 linear weighted moving average applied to low. And the second moving average is almost the same. It's the blue one here. It's the 85 linear weighted moving average applied to low. These two moving averages have several purposes. The first purpose is to serve as a baseline or a home baseline. They give you the general trend, and they give a general support or resistance under which the price is considered in a downtrend, and if the price is above this this baseline, okay, or these baseline moving averages, then the trend is considered, again, in the short term, because it's just a 1 hour trend, is considered an uptrend. Now, obviously, since it's a 1 hour trend, you can see many, even in a downtrend, you can see many times where the price crossed above this baseline, but you can see most of the time that the price is below this baseline, and we'll obviously talk about when to take into account or when to consider the breaking of this trend line or this moving average as the change in the trend, and when to ignore it and consider this this as a false breakout. Okay. Basically, the general idea is when the green or the signal line, the green fast moving average, crosses above the baselines, okay, the slow moving averages, basically it's a signal for long, and vice versa. If it crosses down, it's a signal for short. Now, obviously, you're looking for you're looking to go long or to enter long positions only when the trend is long. Okay, when the trend is an uptrend. And in this case, obviously, when you see here these lines going down, okay, and these moving averages going down, and the price setting lower lows, then you'll be looking for short trades. Now, you can't know for sure that the trend will continue to go down until you see it, but the direction of these moving averages gives you a general direction of the trend. So you should, as long as these moving averages show you that they're going in a down trend, okay, going down, you should look for short trades. One more indication, obviously, is since we have still, although they're both long moving averages, but one of them is a bit faster, okay? The 75 moving average in red is faster than the 85 moving average. So obviously, as long as the 75 moving average is below the 85 moving average, it's another indication of a downtrend, okay? The faster moving average is under or below the slower moving average, it's a downtrend. And vice versa, when we have the red or the faster moving average above the blue moving average, especially if they're both sloping up, then it's more of an uptrend where we'll be looking more for long signals or long entry opportunities. So again, for long, we'll be looking for the base lines to be sloping upwards, preferably with the faster moving average, the 75 above the 85, and we'll be looking to enter long uh, when it crosses or when the price returns to the baselines. Okay, when the price returns to the baselines, and I'll speak shortly about, in a few minutes, I'll talk about these black lines that surround the baseline. And so for long, again, going sloping upwards, red above blue or fast above slow, and the fast moving average or the price above these base moving averages. For downtrend, we're looking for the fast among the two, among the baselines. We're looking for the 75 moving average to be below the 85 moving average. The price obviously below these two long moving averages, or the 5 moving average below these 75 and 85 moving averages. We'll be looking to go short either when it crosses down or when the price comes back to the baseline. Basically, that's the core of the system, but we can see here that we have some other lines, and obviously we'll add some more indicators to help us identify better entry points and golden entry points, as I call them, a combination of several indicators to give higher chances of success to your trades. So what are these black dashed lines? If you double click the 75 moving average, okay, I remind you it's a 75 linear weighted applied to low moving average, and you go to levels, what you can do here is add Fibonacci levels. Okay, now in this case these Fibonacci levels are in hundreds because it's a 4-digit MetaTrader. Okay, ForexPlace uses 4 digits. If it's 5 digits, you will probably have to remove the 0. And we'll see that in other pairs, we might have to also remove the zeros because the S&P in this case works well with these numbers, while other currency pairs might work well with lower numbers. But these numbers are from the Fibonacci sequence, okay, 89, 144, 233, 55, okay. So if you remember the Fibonacci serial numbers, then we have 1, 1, 2, 3, 5, 8, 13, okay, 5 plus 8, 13, 8 plus 13, 21, 13 plus 21, 34, and then 34 plus 21 is 55. That's the first number we have here, okay, or 550. So 55 plus 34 is 89, 89, and then 89 plus 55 is 144, and 144 plus 89 is 233. So basically we have 4 numbers here, 55, 89, 144, and 233. And obviously, in order to reflect them to the other side, we just add the minus sign, okay, before these numbers. So minus 190, or minus 89, minus 144, minus 233, and obviously minus 55. These numbers give us additional levels, just like Bollinger Bands or Keltner Bands have these. Here, let me show you here. Okay, we have the deviations, like 2 deviations or 3 deviations. These are sort of like deviations from the main moving average, in this case the 75 moving average. But these are not exactly deviations. They're just levels or difference between the main moving average and these moving averages by certain points. Okay, and these Fibonacci levels give us additional potential. Okay, obviously potential. support and resistance areas. Now, the price, as you may all know, moves in waves. Okay, price doesn't go directly straight. It goes up and down and up and down, and it finds all sorts of support and resistance levels. And these areas, okay, these Fibonacci levels may help you see other support or resistance areas, and may help you in entering trades or exiting trades if you see the price stop at these levels. Okay, if price stops at these levels, then again it's another indication. Okay, it's just another indicator. It doesn't mean it has to stop in each and every one of these levels, but it gives you another indication of possible areas where the price may stop or may find support or resistance. Now I remind you, this is the S&P. It's not, it's mostly continuous, but sometimes it has these gaps, not only between, not only after the weekend or at the beginning of a new week, but also sometimes in the middle of the night, or especially in shorter time frames. You may see gaps sometimes in the S&P, but again, we're working on the 1 hour chart, so you should see the price pretty much continuous, and you shouldn't have any problem trading the S&P just like you trade any other currency pairs. Of course, take into account the fact that the S&P requires higher margin. Okay, usually with most forex companies, they take more margin when you trade indices or commodities, so just pay attention to that factor. And to the fact that usually before the end of the month, the future contract changes. Okay, so usually they will tell you the trading on the June S&P contract ends at the end of let's say around June 20th or something like that, and you will be able to open new trades only on the new contract, let's say S&P 500 for September, and close existing trades until, let's say, June 27th or something like that. Okay, so these are two factors you should take into account when trading indices like the S&P. First, the margin, and second, the expiry of the future contract. All right, so how do these Fibonacci levels around the 75 moving average help us in trading? Well, as I said, they help us in recognizing additional or possible support or resistance levels in addition to other levels you may see or you may find on the chart. Okay, so for example, let's say you're trading the S&P, and you know, okay, around here that this is a downtrend. Okay, you see a downtrend, and just a sec. Okay, you see a downtrend, and you see that there's a possible maybe a channel here. You know what? Let me just draw a channel. Let's see if this just a sec. Okay. Let's see if there's anything here. Well, not really. Okay. In this case, the price reached. Okay, just around here. No, I'll. Okay, the channel here is not very. I guess it shows well on the 4 hour chart, but I'll try to use the 1 hour chart. So I'll look for. Okay. Where were we? Here. Okay, so let's assume that you're trading, and instead of using this channel, okay, we'll just use this this trend line, and you know, according to these lows, that the price may stop somewhere along this lower line. Okay, Um, okay, it's more or less of a channel, but here there's a false breakout. Well, it's a breakout before there was even a channel. So when you see, for example, you're in a downtrend and you enter short somewhere around resistance areas, for example, around here. You know that this was a resistance area, and okay, this was a resistance support area around this price of 13.44 more or less. It was support, and then the price broke the support line and was used as or this support line turned into a resistance line. Okay, around here and a little bit around here too. Again, it's a false breakout. You can see here too. You enter short. Okay, let's say you decided to enter short somewhere along this resistance line, and you take short, and it's a 1 hour chart. I remind you, it's a 1 hour chart. It's not a 4 hour, 1 day chart. You're trading either intraday or swing trades for just a couple of days. In this case, if you want to take profits, okay, and look for entry points, take profits in this downtrend at some support areas and go and or enter again at some resistance areas, you should know where the price might stop, okay? So let's say you have this downtrend line, then in this case you know that around here or around here when the price touches this downward sloping line, it may find support, okay? But if you can see besides this trend line, okay, let me just delete it. You can see here that you have support around this this line, okay, this dashed line. So the dashed line around here, or around here, around here, all these dashed lines may give you additional, again, additional indication of possible support. Now, I say again, as in every indicator, no indicator by itself can be 100% accurate. Okay, moving averages have their strengths, and trend lines or support and resistance lines have their strengths. Divergences we'll see soon, maybe here even in these downward sloping lows. Okay, these lower lows, we may see a bullish divergence in MACD or in the stochastic. Okay, we'll see soon. But if you have several indicators together, okay, which means a channel line and this moving average Fibonacci level. Okay, it's again, it's a Fibonacci level of a moving average. This Fibonacci level, this moving average Fibonacci level, and you have reversal candles with long wicks, and possibly, you know what? Let's see here, maybe a stochastic divergence. Okay, let's see. Actually, no. On the stochastic, there's no divergence. Wait, just no. Okay, and the MACD, the MACD, no. Okay, so no divergences here. For some reason, I thought there would be a divergence. Here we can see a divergence. Okay, on these lows. Okay, lower lows on the price, but higher lows on MACD. This is a nice bullish divergence, but here we don't see any divergences, but still we see the lower channel line, we see here the reversal candles, we see here the Fibonacci level of the moving average, okay? And again, you cannot know in advance where the price, if at all, okay? But if it does stop in one of these Fibonacci levels, you will never know in advance where it may stop, okay? But if it stops in confluence, in combination with other indicators, it gives you a better signal of entry or exit. Okay, in this case, if you're taking short, then it gives you an exit signal. Okay, you enter short, let's say somewhere around here. Okay, let's say we said something around here, either because of the resistance line or because of the moving averages that serve as resistance, or maybe because of a downtrend. Okay, in either case, if you entered short around this orange rectangle and you take short, okay, you may find exit here or here for sure because of these combining indicators, okay, of the lower channel line and the other indicators we spoke about. So these Fibonacci levels may give you, in confluence with other indications, okay, or with other indicators, possible support or resistance areas, okay? And again, if they come in addition to other indications, then you may see these signals as stronger signals. Okay, you can see here how it stopped exactly around this level, or how here, okay, here or here, how the prices stopped. So they stop in many places, but again, it doesn't mean that you can know where it'll stop in advance. It just means that if you're looking at a certain area and you have several indications or several indicators merging together into this place where you think you should take action, okay, either entering or exiting, then these lines may give you another indication or a stronger indication, okay? Again, for example, resistance here, okay? Resistance here that turns into support, okay, and the support area here comes also with a Fibonacci level. Okay, so you have support from the resistance line that turned into support, and you have support from the Fibonacci level here of the moving average. These are two nice indications for looking for a long entry, especially when you know already that this is an uptrend. Okay, so the risk here is lower because you're entering with the trend, although it may look as if you're entering against the trend, okay, counter trend, but it's actually with the trend, okay? The moving averages are sloping upwards, the 75 above the 85, the price is above these two baselines or base moving averages, and the price sits just on this support line, which was a resistance line before. Okay, now it's a support line and the Fibonacci level. Okay, so these Fibonacci levels again are just extra indicators. I wouldn't recommend using them as standalone because you can never know in which of these levels the price will stop. But if it stops at a certain level, Fibonacci level, in confluence with other indications, that gives you a stronger indication of, in this case, for example, an entry signal if you're looking for long entry, or an exit signal, for example, just like we said around here, okay, where we said we have long wicks when we said we have this support from the Fibonacci level, and we had this downtrend line, okay, this lower channel line. So again, the system, if you want to create it and apply it on the graph by yourselves, you're using 3 moving averages. The first one is a 5 is a 5 exponential moving average applied to close. This is the signal that you should see above the base lines, crossing above them, and giving you also in strong trends, giving you support or resistance. And the two baselines, one is the 75 linear weighted applied to low with 4 Fibonacci levels on each side. Okay, so it's the 55, 89, 144, and 233 in plus and in minus signs. Okay, minus 55, minus 89, minus 144, minus 233. Again, here I added 0 to all these numbers because it's a 4-hour. It's four digits here in Forex Place. So if I remove these zeros, you will see that all these lines come very close to the price. If you're looking for to use these lines on other currency pairs or other instruments, then you may need to change the Fibonacci levels. Okay, let's look, for example, at the euro dollar. You can see here on the 1-hour chart that I don't see any lines. Okay, only if I look at the weekly chart, I see these lines, but they're very far apart. So let's try to for example, to remove these zeros, at least from the positive numbers, and see how it looks like. Okay, now you can see them. Okay, in this case, you can see the lines pretty much okay. And again, if I remove the zeros from the negative numbers too, okay, now I have these lines all around the price, and they're still a bit far away, and you can always try to add other Fibonacci levels. Okay, if you want to try the 8 or 13 or 21 or 34. But as you can see here, these lines are pretty much okay, especially the closer line, the closer lines are 55 and 89. You can see how many times they serve as resistance or support. Okay, sorry. Okay, here and in many other places. But again, you should look at them in addition to other indicators. Okay, let's look at the euro dollar, for example, and see if we could use some of these lines again for support or resistance. So here's a good example of an area where we have more or less a resistance area. Okay, it was a support area. Let's remove this, sorry. Okay, this area was a support area. You can see here, support area. And this candle broke the support area, and now the support level became a resistance level. And here you can see the resistance level, okay, the price reaching the resistance level, and we can see this Fibonacci level, okay, the second Fibonacci level with which is an 89 level for the moving average. We can see here almost like a double top, okay, but there is actually, the price goes a little bit upwards, and you have a divergence here, okay, while the highs go upwards, the MACD, the MACD goes downwards, okay, it gives a lower high or a lower peak, while the price creates a higher peak. So so again, that's a good area if you're for some reason in a long trade. Okay, let's say you entered long because of this reversal candle that found support on the baselines, or because this was a support area. Okay, for whatever reason, if you took a long trade here and you see this resistance area, or even if you didn't see the resistance area for some reason, okay, you didn't notice that it was a support level that was broken, okay, but you see here that the price reaches this Fibonacci level, stops, hesitates, gives reversal candles, reversal patterns, okay, this doji or tombstone and this reversal candle, and especially if you notice the divergence, then all these indicators together should tell you to exit your long trade, and if you're aggressive enough, okay, even to look for a short trade, okay, if you're aggressive or not even too aggressive, okay, because the price stops here for 3-4 hours, okay, then you can always set a stop loss even 20 pips above, and say even if the price goes back to just the home base, okay, to the baselines, and stops here, you can still take around 60 pips, okay, for a 20 pip stop loss. 60 pip take profit is a good ratio, okay, risk reward ratio. So again, you can see here how the Fibonacci level gave you a good indication of support, of resistance, okay. And this is the euro dollar again. I changed the template a little bit, removed the zeros, so just play with the numbers and see if you can, if you don't see the lines, if they're too far away from the moving averages, then remove zeros. If they're too close to the moving averages and all condensed around the moving averages and not around the price, then just add zeros to the Fibonacci levels. This is basically the COP, the COP system, or the COP strategy, which is a center of price. Again, it's a simple one. It just gives you another method of trading. In this case, it was the S&P. Okay. Let's again put the S&P. Okay, so it gives you a good, if you're looking for trading strategies for the S&P, again, always look for going with the trend and look for entry opportunities around the baseline, okay, the moving averages, or when the 5 moving average returns to the longer moving averages around here, for example, and here. Sorry. Okay, here and here. Okay, so when the 5 moving average returns to this home base or to these longer moving averages, that's a place where you can look for entering with the direction of the longer moving averages. If you have any questions, again, please don't hesitate to write them down. And I will, in the 20 minutes we have left here, I want to talk a little bit more about moving averages. Some guys asked me about my moving averages, the moving averages they saw in one of my templates. Here, this template. Okay. By the way, I remind you, obviously, we can see here the pivot lines. You can always, and you should always, set the pivot lines on your trading charts, even on the S&P. Okay, so you can always add the pivot lines. Where are they? Here, the pivot points. Okay. Setting the pivot points will also give you a good indication or a possible area for resistance or support. Okay, not always, but it's another indication you may find useful. These moving averages, Okay, the moving averages you can see here on the screen right now. There are many here. Okay, and obviously, just like I said on regarding the Fibonacci levels, you can't know for sure and ahead of time on which of the moving averages the price will stop, okay, or find support or resistance. But I will tell you, I will review these moving averages and I will give you some helpful methods how to use them or how they can help you in your trading. Again, it doesn't go well with other trading strategies because then you have just too many indicators and too many lines, and it's just another way of looking at the price action or the chart using these moving averages, but I wouldn't recommend adding these moving averages to another system, okay, or to another indicator on the price itself. Basically, except for the white moving average, which is a 35 simple moving average, all the other moving averages here are exponential moving averages. Let me just remove the 35 first. These are all exponential moving averages. Okay, you can add or remove some of them. Again, it's up to you, but I just want to show you the general idea of moving averages. Okay, in general, how they can be useful for you and how you can look at them not only for crossing but also for support and resistance and for a general feeling of the graph or the chart, how the momentum of the price, okay, on not like the momentum indicator, but the momentum of the price itself. When you see these shapes, these fans created by the moving averages. Basically, the moving averages I'm using here are well, sometimes I have the 5 moving average. Okay, all the moving averages again are exponential. But I'm talking about 5. Here we have 9. Okay, 9 exponential, all apply to close. So we have 9, we have 13, 26, 52, 100, okay, 100, 144, and 200. Now, obviously, these are, it may be even too much, okay? And it may be confusing because you say, okay, I don't know if it'll stop here or there. And let's say I'm going upwards, okay? Or I think I want to trade with the trend upwards, or just open a short trade. I don't know if it'll stop on one of these shorter moving averages or lower moving averages, especially if I change time frames, okay? Because let's say I change to from a 15-minute chart to a 1-hour chart. Then in this case I have, on the one hand, the 15-minute chart gives me a good indication to go long, okay? But the 1-hour chart, according to the moving averages, gives me this chart gives me a short signal, okay? Or most of the moving averages are going downwards, and I have many resistances. I have the 100 moving average above, and I have the 144 and the 200. So how do I know what to which moving average I should pay attention? Should I pay attention to the shorter time frame moving averages or the long time moving averages? And my answer basically is to all of them, but it doesn't mean you have to trade by them, but just pay attention to them. If you're using these moving averages, you should pay attention to them in case you're taking especially short time trades, okay? Not long time trades, but short time trades. What do I mean? Let's say you're trading the euro dollar this morning, or the pound dollar in this case. Okay, you're trading the pound dollar this morning, and it's an uptrend. Okay, it was gapping with a gap upwards, and sloping upwards with higher highs, higher lows. The price sitting pretty much on the shorter or the faster moving averages, and you're looking for fast uptrends, or for fast long entries. Okay, so let's say you enter anywhere, doesn't matter where, and you see the price stop here, okay, around here and around here. How will you know, okay, when the price might turn around against you? Okay, how do you know? Okay, this price, this here area here is just a small retracement, but this one might be a longer retracement. So in this case, what I suggest, or what I do, is I organize my charts, let's say 4 or 5 charts from the same currency pairs, the same currency pair on one screen. Okay, I just organize them in 4 or 5 different time frames of the same currency pair, and I look for potential supports or resistances. For example, you can see here that on the 15-minute chart, the pound dollar stopped. Okay, found resistance. Now, it may be because of the resistance here. Okay, here there was strong resistance, and it may also be because of the because of this 100 moving average. Okay, so again, if I know that I have 2 resistances here, first of all, resistance from the price, from the 15-minute chart, the resistance I saw around here, and the 1 hour chart gives me a resistance of the 100 moving average. Now, obviously, it could have stopped on any other moving average, okay? But if I have, just like I said before, combination of several indicators together, that's a stronger indication, a stronger signal, you have stronger potential of finding resistance, finding support, reversal, entering or exiting. It depends how you look at it. In this case, if you're in a long position and you see the price stop around the support, the resistance area, and below the 100 moving average, it gives you a strong signal, okay, that of resistance. Okay. Now the 15-minute chart doesn't show you the moving average, the 100 moving average on the 1 hour chart. Okay, that's why I use multiple charts, okay, or multiple time frames. For example, I will create a new profile. Okay, I'll show you how to create a new profile. You click on this button here, the default button, or the profiles button, or you go to File, Profiles, and you create a new profile, save as, and let's say I call it GBP USD, and then I arrange my my charts just like I want. Okay, so let's close all the charts, and let's open just a few pound dollar charts. Okay, let's say I open 4 charts, or you know what, let's say even 3. I can tile them, and I can set whatever template I want on these charts. Okay, and different time frames. Let's say 1 hour and 4 hours. Okay, 15, 1 hour, and 4 hours. So I see here around this area, I see when the price reaches this area of 157.15, I see here, Okay, let's say I already analyzed the chart before. Okay, and I know that there's a resistance area here around here. Okay, here it's support and resistance again. So I know I have resistance here on the 15-minute chart. I know on the 1-hour chart that I have this 100 moving average, and again I know from this chart that I also may have resistance around here. So I know I have this moving average, and on the 4-hour chart you can see here that I have several resistances. I have, let's make it even larger, I have the 52 moving average around here. Okay, sorry, the 26 moving average around here. I have weekly pivot line around 157.10. Okay, so I have two resistances on the 4-hour chart. I have the 100 moving average on the 1-hour chart, and I have this resistance from the 15-minute chart. All these together tell me you have major resistance here. Don't enter long. If you're already in a long position and you're just swinging or in a short-term trend or short-term trade, you should exit around here, and let's say you're aggressive, you should look for short opportunity here too. And I would even give you another signal here. Okay, you have these highs going up, while the indicators, the stochastic and even the MACD, the MACD, give you bearish divergences. Okay, so you have divergences, you have resistances from previous price actions, from moving averages on both 1-hour chart and 4-hour chart, and you have the pivot lines. Okay, in this case the weekly pivot line. So I would say one resistance, two resistances, 3 from the moving average, 4 from the pivot, 5 from the bearish divergences. 5 reasons to look for a short trade, or at least to close your long trade, or at least, and obviously not to enter a long trade. Okay, so you have 5 good reasons or 5 good resistances, okay, or indications for potential reversal. This is what I call a golden trade, okay, or a golden indicator or indication, because we have so many indicators pointing at the same direction, or let's say the same possible move, in this case a downward move. Okay, that these are the things you should look for. Okay, and just like I said regarding the COP, the center of price Fibonacci levels of the moving average, they are not a standalone indicator. They just give you another indication, but if they converge with other indicators and give you the same signal, then it reinforces your chances, or makes your stronger your chances of taking a winner. These indicators make your chances much higher. Okay, so you should be patient and look for these opportunities, for these trades, for these golden trades, for these merging indicators, and this confluence of indicators will make your chances of good trades much, much higher. Okay, now this is just a pound dollar. Let's say I want to create a profile for the euro dollar. What I'll do, I'll save a profile Okay, I'll save a profile as Euro USD. Okay, and then if I want, I can, you know what, let's first remove all the marks I did, and I'll just drag the euro dollar to these charts, open charts. Okay, and you see here I have now a profile of the euro dollar. If I want to go back to the pound dollar, all I need to do is click the profile button, go to the pound dollar. Oh, okay, didn't. Oh no. GBP. Okay. For some reason, it didn't save the pound dollar profile. I don't know why. Okay, let me create it again. I'll just go to the pound dollar. Oh, strange. Okay. Sorry. So you can always reapply the templates you want, and it should save them in the under the profile. Let's see now, euro dollar, and let's go back to the pound dollar. Okay, now it's okay. Just change the time frames. Okay, so let's go to the euro dollar. Okay, we have the 15-minute, 1 hour, and 4 hour charts. And again, regarding the moving averages, I'm looking for indication or confluence with other indicators. Okay, so basically the 15-minute chart, all it gives me here is maybe a resistance signal around here. Okay, we have support, we have resistance, and again resistance here. Okay, the moving averages are here, are only for support. Before this resistance area here, moving averages were only served as support, but here, let's see on the 1 hour chart. Well, you can see here that on the 1 hour chart, unlike the pound dollar that stopped dead on the 100 moving average, here it didn't. Okay, it didn't stop. In the 4 hour chart, well, here again we have the weekly pivot, and we have the 26 moving average. What I can see here is that these two moving averages may start serving as support instead of resistance. Okay, so we may see here a shift from resistance under these moving averages to support. Okay, now here these moving averages may serve as support. If the price pushes up, then these will start going up with the price and serve as support under the price. Okay, below the candles. The 9 moving average will cross the 13 moving average, and again will serve as support, just like here it served as nice resistance. Any questions? Anything you want to ask about the COP strategy or these moving averages? Again, it's just I showed you the moving averages I sometimes use, but you know, it's nothing. It's not a precise science. Okay, it's not something you can say. Okay, this moving average will be for sure the last resistance, or this moving average, but it may help you sometimes. Okay, I think I mentioned last week that on the pound dollar, when I saw the price going up all the way and crossing all these moving averages, the 200 moving average is known to be a very strong moving average. And you know, let's see if yeah, you see here that the price didn't even reach the trend line. Okay, it stopped right at this moving average, the 200 moving average, and from there it dropped 650 pips. Okay, so this, for example, for me was a good indication of possible reversal point, even though it was almost a standalone. Okay, because I didn't see many divergences before. The price was going up really strong. Okay, really with no barriers. Uh, it didn't show any sign of weakness, and you can see here that there wasn't any special resistance or support area here. Okay, nothing, well, a little bit, but nothing really special you see here. But still, the 200 moving average on the weekly chart made the difference here and really pushed the price down. So again, it's just uh, an indicator. It's not a wall. It's not something you can know for sure, but it's something you should pay attention to, and you can always try to find your own moving averages, the ones that you consider better for the currency pair or better for your time frame. Any questions? Anything you would like to ask regarding the systems we saw earlier? John, you're asking where you can get the programs to access all the charts or moving averages that I've been showing. So again, just like I mentioned before, all the indicators and the templates, all of them, you can ask your account manager to send them to you. Okay, and if you have specific questions or specific things you want, like the pivot points that I'm using, or maybe things that your account manager doesn't have, you can always write me an email. Okay, just like I wrote here on the chat, yanko.fx at gmail.com. Okay, so you may always send me an email. Any questions, guys? Okay, again, later on this week, we'll try to, maybe Wednesday morning, we'll try to see in real time how to use these systems, these indicators, and not just in hindsight, but really in real time, maybe on a 5-minute chart, maybe even on a 1-minute chart, you may find these some of these systems and moving averages and indicators useful. The 200 moving average is exponential. All the moving averages I'm using are exponential. The only one which is not exponential, and I use it sometimes because it may give sometimes good resistance or support indication, is the 35 simple moving average. Okay, just look at it. I mean, you can set these moving averages on the graph on your chart and see how you feel with them. Some of them, all of them, just one or two. Again, we'll see many other trading systems, and we'll find some of these moving averages in these trading strategies. Okay, in these systems. Okay, the 5 we saw it earlier. Sometimes the 9 moving average. The 150 we saw it in the knife, which is almost like the 144. The 100 moving average is a very strong one, and the 200 moving average is also a very strong moving average. Okay, and since our webinars are short, just 1 hour each, I don't review everything at once, but you'll see as we go on, I'll reveal more and more of how to use some of these things together: the moving average, the pivot lines, the divergences, multi-time frames indicators, all these things together. Okay, so thank you very much for attending. Tomorrow evening we'll review some price action strategies, And I'll be happy to see you again later on this week. So really have a good day or a good week, good trading week, and good luck. And thank you again for attending. Thank you.